At the close on July 17th, all three major U.S. stock indexes finished lower, although the declines were modest. But the support structure beneath the indexes is undergoing a profound change. Over the past month, the Technology Select Sector Spider Fund, or XLK, has fallen by approximately 8.6%. The technology sector has recorded net outflows of $8.7 billion. According to Goldman Sachs, hedge funds were net sellers of technology stocks in 6 of the past 8 weeks. The market value of their technology holdings fell by approximately 10%, marking the largest reduction in exposure since the data series began more than a decade ago. Institutional investors are exiting, while retail investors are taking the other side. Meanwhile, the Energy Select Sector Spider Fund, or XLE, has gained approximately 7.2% over the past month, while the S&P 500 has declined by only around 0.3% over the same period. The healthcare sector has risen by approximately 6.1%, financials by around 4.4%, and communication services by roughly 3.7%. Wall Street is now telling a story of the market shifting gears. The weighting structure of the S&P 500 will determine how this story develops. Information technology accounts for approximately 36.8% of the S&P 500. Financials represent about 12.4%, healthcare about 9.1%, communication services about 9.9%, and energy only 3.3%. Energy has delivered the strongest gains, but its weighting is too small to support the index on its own. The sectors truly holding up the index are financials, healthcare, and communication services, which together account for more than 31% of the S&P 500. Technology remains a necessary condition for the index to rise. With a weighting of 36.8%, the broader market will find it difficult to mount a sustained advance unless technology stabilizes. But clear divergence has already emerged within the technology sector. Semiconductors have generally remained weak, while Microsoft has risen from approximately $367 to around $402 over the past month, significantly outperforming the technology sector as a whole. The following 4 stocks are the names most worth watching in the current market rotation. 1. Microsoft, the relative strength exception within technology. On July 20th, Microsoft announced that it was expanding its long-term strategic partnership with AMD. Microsoft will deploy AMD's latest Helios AI platform and next-generation EPYC data center processors on Azure. The AMD Helios platform integrates Instinct MI455X GPUs, 6th-generation EPYC Venice CPUs, Pensando networking technology, and ROCm software, creating a full-stack AI computing platform. AMD expects to begin shipping the platform to customers, including Microsoft, in the second half of 2026. The main significance of this announcement is that Azure is not reducing its AI infrastructure investment. Instead, it is expanding its hardware supplier base and increasing its computing capacity. The market's biggest concern about AI capital expenditure is that companies may be investing too much while generating too little return. Microsoft's decision is a direct response to that concern. Microsoft closed at $402 on July 17th. The analyst consensus rating is moderate buy, with an average price target of approximately $557. Both Deutsche Bank and Bank of America believe that Microsoft offers an attractive entry point ahead of its earnings report. From a technical perspective, the MA5 is approximately $395. The MA10 is around $391, and the MA20 is approximately $382. The share price is trading above all of its short and medium-term moving averages. However, the $403 to $406 range is a dense area of previous highs. An intraday breakout alone is not enough to confirm that the trend will continue. For Microsoft, the most attractive setup would be a shallow pullback to between $397 and $400, or a deeper move into the main position building zone of $390 to $394. The real confirmation point will be the July 29th earnings report. Azure growth, AI capital expenditure, and free cash flow must all pass the test at the same time. 2. Exxon Mobil, the most structurally resilient choice in energy. On July 7th, Exxon Mobil filed an 8K report with the SEC, disclosing that its second quarter earnings were expected to be approximately $5 billion higher than in the first quarter. The Wall Street consensus estimate for second quarter adjusted net income is approximately $15.7 billion, roughly 3 times the first quarter figure. The company will release its full earnings report on July 31st. At the same time, the conflict between the United States and Iran has continued to escalate. Iran opened fire on commercial vessels in the Strait of Hormuz, after which the Trump administration revoked the general license that had allowed Iranian crude oil to be sold in global markets. Brent crude rose by approximately 12% in a single week. Exxon Mobil reached as high as $144.60 in pre-market trading on July 8th. Barclays reiterated its buy rating with a price target of $184, while JPMorgan also maintained its buy rating with a target of $158. Energy is the strongest performing sector in the current rotation. What distinguishes Exxon Mobil from other energy stocks is that it issued its own earnings guidance directly, rather than relying only on broader industry trends. With geopolitical risks still elevated, the $144 to $146 range represents short-term support, while $140 to $142 provides stronger support. For Exxon Mobil, the strategy is to wait for a pullback rather than chase the stock on the same day that oil prices surge. If the stock closes above the $150.50 to $152 range, the next upside target could be between $155 and $160. 3. JPMorgan Chase, the large bank with the most complete candlestick structure. On July 14th, JPMorgan Chase released its second quarter earnings report. Adjusted earnings per share were $6.14, exceeding Wall Street's expectation of $5.85. Revenue reached $52.4 billion, above the expected $50.2 billion. Net income was $21.2 billion, representing year-over-year growth of 41%. Investment banking and equity trading revenue were the main sources of the earnings beat. Following the earnings release, JPMorgan shares rose by approximately 7%. The stock reached an intraday high of $351.24 on July 15th. It then entered a period of profit-taking over the following 3 trading sessions and closed at $338.87 on July 17th. Bank of America raised its price target for JPMorgan to $420. For JPMorgan, the $330 to $335 range is an important support zone to watch, provided that the stock forms a long lower wick or a bullish engulfing pattern. Only a close above $351 would confirm the beginning of a new upward trend, with an upside target of approximately $360 to $365. If the stock falls below $325, the logic behind the post-earnings breakout would largely be invalidated. 4. Meta, the main driver of the communication services sector. Meta has been the main driver of the recent rise in the communications services sector. As of July 16th, Meta had gained approximately 21% during the month, making it the best performing member of the Magnificent Seven. On July 1st, reports concerning its AI cloud business pushed the stock up approximately 9% in a single session to $612.91. Meta then rose by 4.7% on July 9th and another 6% on July 10th. After reaching a high of approximately $686 on July 15th, the stock pulled back to around $646 and entered a technical correction. Meta's rally is supported by three factors. First, the market has responded positively to its business model of selling external access to its AI infrastructure and computing capacity. Second, the release of the Muse Spark 1.1 AI model has been viewed as one of Meta's most meaningful AI model launches. Third, the market expects Meta's share of the digital advertising market to reach as much as 27% in 2026, surpassing Google. However, the risks are equally clear. Meta's capital expenditure in 2026 is expected to range from $125 billion to $145 billion. Its large-scale AI investment is both a catalyst and a valuation risk. Meta currently trades at a price-to-earnings ratio of approximately 20.5 times. The strategy for Meta is to wait for the pullback to stabilize. The $636 to $645 range is the first support zone, while $626 to $636 is a more attractive area to watch. If the stock closes above $665, the next upside targets are $681 to $686, the previous high area, followed by $705 to $710. A break below $620 would indicate that the short-term technical structure has weakened significantly. Based on sector strength, influence on the index, the durability of the news catalysts, and the current price structure, the four stocks can be ranked as follows. First, Microsoft. Microsoft is showing relative strength within the technology sector and has the greatest influence on the broader index. Its pullback levels are also clearly defined. The $390 to $400 range is currently the highest quality entry zone. The July 29th earnings report is the key confirmation point. Second, Exxon Mobil. The energy trend remains strong, supported by both geopolitical risk and the company's earnings guidance. The news flow and price action are confirming each other. The $144 to $146 range is the first area to watch. Third, JPMorgan Chase. JPMorgan has delivered the strongest earnings performance in the financial sector. However, investors should wait either for support to emerge between $330 and $335 or for a confirmed breakout above $351. The positive earnings news has already been released, and the market needs time to absorb it. Fourth, Meta. Meta is the leading stock in the current rise of the communications services sector, and the market is beginning to validate the logic of its AI cloud business. The stock is currently undergoing a technical correction. The $626 to $636 range is a more reasonable area to watch. The market has not fundamentally changed direction. Large amounts of capital have not left the market. They have simply moved away from the technology sector for the time being. And the market's new pricing anchors are spreading beyond technology into broader areas such as energy, financials, and communications services.